$613 billion in assets, $619 billion in debt, 158 years of survival, wiped out in a single weekend. On the 15th of September, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. It remains the largest corporate bankruptcy in American history. If you watched the previous episode, this was the panic that broke Madoff. One man could have sold the firm. He refused. 3 men in Washington could have saved it. They chose not to. At 10 o'clock on Sunday evening, the chief executive of Lehman Brothers, a 62-year-old former bond trader named Richard Severin Fuld Jr., sat in his 31st floor corner office at 745 7th Avenue, watching Times Square through the rain. Across the street, at the New York Federal Reserve, the chief executives of every major bank on Wall Street had spent 72 hours trying to find a buyer for his firm. Bank of America had walked Saturday. Barclays had been blocked that afternoon by the British Financial Services Authority. Treasury Secretary Henry Paulson had told the room that no public money would save Lehman. The market needed discipline. A bailout would only reward recklessness. 6 months earlier, the same 3 men had backstopped $29 billion to rescue Bear Stearns. Lehman was 4 times the size of Bear Stearns. Fuld had assumed the precedent applied. It did not. To understand what was lost that night, you have to understand what Lehman Brothers had been. It was the oldest continuously operating investment bank in the United States. In 1844, a 22-year-old Bavarian immigrant named Henry Lehman, born in Rimpar, arrived in New York and made his way south to Montgomery, Alabama, the following year. He opened a dry goods store on Commerce Street, selling tools, seeds, and fabric to cotton planters. In 1847, his brother Emmanuel joined him from Bavaria, and the storefront became H. Lehman and Bro. In 1850, their youngest brother Mayer arrived, and the sign was repainted. Lehman Brothers. Cotton planters preferred to pay in raw cotton rather than cash. By the late 1850s, Lehman had transformed itself into a cotton brokerage firm. Henry died of yellow fever in 1855. In 1858, Emmanuel opened a New York satellite office. The Civil War followed, and the firm continued under Emmanuel and Mayer. By 1887, Lehman Brothers held a seat on the New York Stock Exchange. Over the next century, the firm survived everything American capitalism could throw at it. The Panic of 1873, the Panic of 1907, the crash of 1929, the Great Depression, Black Monday in 1987, long-term capital in 1998, the dot-com collapse in 2000, a bank older than the light bulb, and on the morning of the 15th of September, 2008, it was finished. The man who would preside over the destruction of the firm was the last man anyone at Lehman had expected to lose it. Richard Severin Fuld Jr. was born in New York City in 1946. He graduated from the University of Colorado at Boulder in 1969 and joined Lehman Brothers as a summer intern in commercial paper trading. He never worked anywhere else. For the next 25 years, Fuld traded fixed income through every conceivable market structure. He was, by every contemporaneous account, exceptionally aggressive and exceptionally hostile to anyone he perceived as disloyal. His nickname on the trading floor was the Gorilla. In 1994, the board named him chief executive of the newly independent Lehman Brothers Holdings. He was 48. He would hold the title for 14 years. Under Fuld, Lehman grew at a pace that made it the envy of Wall Street. Revenue rose from $2.7 billion in 1994 to $19.3 billion in 2007. The stock climbed from $4 to a peak of 86 in February of 2007. Fuld's personal stake, on paper, exceeded $1 billion. He ran the firm from the 31st floor of 745 7th Avenue, reached by a private elevator that opened only with a key Fuld himself carried. By 2007, it was understood inside Lehman that disagreement with the chief executive was a career-ending offense. By 2006, Lehman was originating more subprime mortgages than any firm on Wall Street. By 2007, they couldn't sell a single one. The decision that destroyed Lehman was not made in September of 2008. It was made between 2003 and 2006. A top-down call by Dick Fuld and his president, Joe Gregory, to bet the firm on American residential real estate. By the early 2000s, Lehman was a dominant force in mortgage securitization, bundling thousands of home loans into bonds, slicing them into tranches by credit rating, and selling them to pension funds, insurers, and foreign banks. With American house prices rising almost 10% a year, it appeared nearly riskless. Between 2003 and 2006, Lehman tripled its origination capacity. The firm acquired Aurora Loan Services, a major originator of so-called Alt-A loans, those made to borrowers with limited documentation. $47 billion in a single year. Securitized, tranched, sold, booked as profit. What changed in 2006 and 2007 was that Lehman stopped being able to sell the bonds fast enough. Buyers were paying less, yields were widening. Other firms, Goldman Sachs most famously, but also Deutsche Bank and JP Morgan, had quietly started shorting the very instruments they were selling. Lehman did the opposite. Lehman doubled down. By the end of 2007, the firm held roughly $85 billion in mortgage-related assets it could no longer move, nearly 4 times its shareholder equity. A 10% decline would wipe out 40% of the firm's capital. A 25% decline would render Lehman insolvent. On Sunday, the 16th of March 2008, JP Morgan Chase agreed to buy the 85-year-old investment bank Bear Stearns for $2 a share, later raised to $10. The deal was made possible by a $29 billion Federal Reserve guarantee against losses on Bear's toxic mortgage assets. The architects, Treasury Secretary Henry Paulson, New York Fed President Timothy Geithner, and Fed Chairman Ben Bernanke. Inside Lehman, the rescue was read in exactly the wrong way. If Bear was too interconnected to fail, then Lehman, 4 times larger, was unquestionably too interconnected to fail. The Fed would not let Lehman go down. What Lehman did instead, that spring and summer, was disguise the true size of its balance sheet. The technique had a name. Internally, it was called Repo 105. Just before each quarter close, Lehman would transfer $50 billion of assets, typically illiquid mortgage bonds, to a counterparty bank in exchange for cash. After the public financial statements were filed, Lehman would buy the assets back, with interest. Economically, a short-term loan. Legally, Lehman classified it as a sale. The classification mattered. As a sale, the $50 billion disappeared from the balance sheet at the moment investors were looking at it. The cash was used to pay down other liabilities. The firm's reported leverage looked dramatically healthier than it actually was. No American firm would sign off on it. Lehman went to London and obtained the opinion from Linklaters under English law. The full mechanics would not become public for another 18 months, when a court-appointed bankruptcy examiner published a 9-volume report in March of 2010. By June, Dick Fuld was firing the only people who told him the truth. After Lehman reported a quarterly loss of $2.8 billion, Fuld removed 2 of his most senior lieutenants in a single afternoon. The firm's president, Joe Gregory, Fuld's closest ally for 30 years, was out. The chief financial officer, Aaron Callan, who had publicly defended the firm's mortgage book on television and on earnings calls, was out. The firings did not restore market confidence. They confirmed what hedge funds and short sellers had been arguing for months, that something was seriously wrong inside Lehman Brothers. Over the summer, Fuld held private meetings with potential outside investors. The most serious talks were with the Korea Development Bank, a state-owned South Korean institution, and with Bank of America. In every conversation, Fuld insisted on a valuation for Lehman that the potential buyers regarded as detached from reality. On Tuesday, the 9th of September 2008, the Korea Development Bank publicly announced it was walking away. Lehman's stock, which had opened at $14.75, dropped 45% by the closing bell. By the end of that week, the credit rating agencies were warning of imminent downgrade. A downgrade would force Lehman to post billions in additional collateral to its trading counterparties, collateral the firm did not have. On Friday morning, Treasury Secretary Henry Paulson called Dick Fuld and told him, in plain language, that Lehman Brothers had until Monday morning to find a private sector buyer. There would be no federal money. The market, Paulson said, had to be allowed to discipline itself. What happened at the New York Federal Reserve between Friday evening and Monday morning has been the subject of 9 books, 3 congressional inquiries, and 1 Pulitzer Prize. What follows is the compressed version. At 6 o'clock Friday evening, Paulson, Geithner, and SEC Chairman Christopher Cox convened the chief executives of every major investment bank in a 13th floor conference room at 33 Liberty Street. Goldman Sachs, Morgan Stanley, Merrill Lynch, and 4 others. Paulson opened by telling them no federal money would rescue Lehman. The room would find a private sector solution before Asian markets opened Sunday evening, or there would be no Lehman Brothers on Monday morning. Over the next 48 hours, 2 rescues took shape. The first was Bank of America. Ken Lewis arrived Friday evening, examined Lehman's mortgage book through Saturday, and concluded by Saturday night the losses were larger than anything Lehman had disclosed. On Sunday morning, Lewis walked. He spent Sunday afternoon agreeing to buy Merrill Lynch for $50 billion in stock. The second was Barclays of London. The British bank wanted Lehman. By Sunday morning, the 2 sides had an agreement in principle. What Barclays needed, under British law, was a temporary federal guarantee on Lehman's trading book between deal signing and the shareholder vote. The British FSA would not waive the vote. The U.S. Treasury would not provide the bridge. At 2 o'clock Sunday afternoon, Barclays collapsed. By 6 o'clock, with Asian markets 30 minutes from opening, Paulson, Geithner, and Cox had run out of options. Paulson telephoned Dick Fuld and told him to file for bankruptcy before markets opened. Fuld asked whether the Federal Reserve would consider, at this last hour, any form of liquidity facility. Paulson said no. The conversation lasted under 3 minutes. At 1:45 in the morning, the largest bankruptcy in American history was filed by a firm older than the light bulb. Lehman Brothers Holdings filed Chapter 11 in the Southern District of New York. $613 billion in assets, $619 billion in liabilities, 25,000 employees on 6 continents, 1 million separate creditors. When the New York Stock Exchange opened that morning, Lehman common stock, which had closed Friday at $3.65, down from $86 18 months earlier, opened at 21 cents. Fuld's personal stake, worth more than $1 billion at the 2007 peak, was now worth approximately $65,000. What happened over the next 4 days was not the disciplined, contained correction Henry Paulson had promised. On Tuesday, AIG, which had written $180 billion in credit default swaps against the very mortgage bonds Lehman had been packaging, told the Fed it would be insolvent within 24 hours. That evening, the Fed extended AIG an $85 billion credit line. The market discipline argument was abandoned within 36 hours of being made against Lehman. The same day, the Reserve Primary Money Market Fund broke the buck, the first to do so since 1994. By week's end, $2.4 trillion had fled money market funds. The short-term markets that underwrite corporate payroll and trade credit had stopped functioning. On Thursday, Paulson and Bernanke walked into the Capitol and told leadership they needed $700 billion within 7 days, or the banking system would collapse by month's end. The bill refused for Lehman had been written, instead, against the entire economy. The bankruptcy of Lehman was not, in the end, a story about one autocratic CEO in denial, though Dick Fuld was certainly that. It was a story about the choice the U.S. government made that weekend to let one institution fail to prove it was serious about market discipline. The proof failed. The discipline collapsed. The bailout refused at $29 billion became, within 72 hours, a $700 billion bailout of everything else. 3 months earlier, the SEC had chosen not to act on Madoff. That weekend, Treasury chose not to act on Lehman. The pattern was institutional, not personal. Fuld testified before the House Oversight Committee on the 6th of October. He told them no one had told him the firm would fail. He was not charged with any crime. He kept roughly $500 million drawn from Lehman between 2000 and 2007. Today, he is 79, and runs a small private equity firm in Greenwich, Connecticut. Next time on Empires of Money, American International Group. $180 billion in credit default swaps. The $85 billion bailout that Paulson refused to write for Lehman and signed 36 hours later for AIG.